Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeremy Schwartz, Global Chief Investment Officer of Nasdaq-listed WisdomTree, to discuss his outlook for rates, inflation, and the role dividend stocks are going to play in this environment. Jeremy, it's great to see you. Welcome to Trade Talks.
Jill, thanks for having us. Great topic for the day.
It certainly is. And I guess $1 million question, of course, Jeremy, is how many rate hikes do you think are feasible that we could get this year?
You know, it's amazing how fast the market has come. I mean, just today we got another PPI report. You're seeing these numbers come in very, very hot. We were early on the thesis that the market wasn't correctly figuring out what the Fed was going to do. The Fed's coming quicker. We're closely watching. Powell's going to be giving a Humphrey Hawkins testimony in the next few weeks. That may be more important than the first Fed meeting. Like, we think there's a real chance they go 50 at this first Fed meeting. We were early saying they could go as much as 8 hikes. Nobody was talking 3 hikes when we started saying 8. We're saying they can get really, more aggressive, but we see inflation being a real problem. But obviously the data will dictate. The market's come a long way in pricing in these additional Fed hikes, but we're on the inflation is hotter than most people expect for longer than they expect. And so the Fed will adjust to that reality.
Is inflation solely about the supply chain or rising prices?
It's about that the Fed's not talking about is the money supply. So if you go way back, the Fed talked about the money supply, and you've had this huge double-digit money supply growth, 12-13% a year. And so this money in the economy, it's different than the quantitative easing during the financial crisis when all these excess reserves sat on bank balance sheets and didn't go into the real economy. Now you have this huge money supply growth that's in the economy. It's in people's checking accounts. And so yes, the supply chain is a factor. You need more labor supply. You need more goods. You have all those bottlenecks of COVID, but it's the money in people's checking accounts that is ultimately pressuring the demand. And so we see that as a persistent factor. We've been saying 20-25% cumulative inflation from the pandemic. We're probably halfway there. We think there's still more to go on that inflation. And so yes, supply chain is one factor, but it's the money supply is the key factor.
That's interesting because you would think, okay, for the average American, they have more money in their checking account. That's a good thing. So how can slowing down the increase of the money supply combat inflation? Don't we want people to have healthy checking and savings accounts?
And you can see the central banks being in a weird position. The Bank of England, one of their heads were saying, don't ask for raises. You're putting too much pressure on wages. That didn't resonate with the average person. We want our wages to go up. And wages are going up. I mean, that's one of the things about this that's also going to keep inflation hot is that people are saying, give me a wage increase. I've been seeing the inflation. And so I think you are going to see more wage pressure that will support further demand and keep some of these inflation pulses coming for the next few years.
Why are dividend stocks attractive in this environment?
The way people allocate, there's stocks, there's bonds, and then other things, so commodities and other real assets. Stocks are real assets. Companies, when you see in the earnings reports, companies say they're passing along the price increases. You see it across the economy. People are passing along those increases. And so companies, because that they do pass along you got a producer input this morning, it goes up, the companies pass along to consumers. Earnings and dividends tend to grow with inflation over time. You go back 60, 70 years, inflation was 3.5%. Dividend growth on the market was 2% above inflation. And so you get real growth on top of that. You look at where TIPS bonds, after inflation yielding bonds today, negative 40 basis points. Instead, you could get 3% on large cap dividend paying stocks, higher dividend stocks that grow with inflation over time. That to us is a attractive proposition.
So let me throw one more question at you, Jeremy. When do we think inflation is under control? When does the Fed decide that it doesn't need to do any more rate hikes? Is there a specific percent? Is there some other data that they're looking at that lets them know, okay, this policy worked out? Yeah,
I mean, their long-term target is 2. They were talking about what was below average trend and it could go above average for some time before it caught up to the trend. We're getting close to that catch up to their long-term trend, which is why they're going to start to adjusting it. So the question will be, how quick can they get back to the 2% levels? And again, we think it's going to be some time. If you have 7% inflation, should you really be at 1% interest rates? Is that going to really do it? Not to us. And so we do think it's hiking faster, but they're looking for 2% inflation ultimately as their longer run targets.
All right, Jeremy, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.